Good afternoon, everybody. Good morning for those of us who are joining from the US, and good evening for those who may even be joining us from Asia. And welcome to the Refinitiv webinar on regulatory trends in 2020. Regulation, as we all know, is a ongoing area that addresses all of our professional lives with regards to change that we have to reflect. So today's event, we've brought some members of the Refinitiv team together with Michael from Deloitte, and we'll walk through some of those regulatory trends that we're anticipating in 2020. Before we get into the meat of the presentation, just some housekeeping with regard to how to use the tool that's at your disposal. You'll see some widgets at the bottom of the screen. Through those widgets, you can pose questions. You can drag them in and out of the various aspects of your screen real estate so you can see what's going on. You can respond to our polls that we'll be asking you real time, so please feel free to engage and use those widgets as you go through. That could be a technical query, can't hear sound, something along those lines, sliders stuck, or it could be more of a content question, and we'll look to incorporate those into the webinar as we go through the event. Typically there is a pop-up survey at the end, so if there is in this instance, then we shall ask you to fill that out. As we touch on here, the slide deck and the recording of the webinar will be available after the event. Some technical points. Refresh your browser and so on, you may find that things move on. The other element that I would introduce, perhaps not unusually now as we're sort of 3 months in, a lot of us, to lockdowns and semi-lockdowns, is most of the presenters, as you'll see from the background, are working from home. So there may be uninterrupted voices from respective people's children and the like. Never work with children and animals, as they say, so not a lot you can do when you're at home with them. So and now would obviously be a great time for Amazon to make a delivery. So if any of those things happen, please just understand as we go through. In terms of who we have today, joined by, as I say, a collection of internal and external speakers. My name is John Mason. I'll be your moderator today. I'm the head of our pricing and reference data at Refinitiv. My background has typically been in that market data, global reference data area of the business, be it with Refinitiv or prior to Refinitiv with Bloomberg, and then within the industry as a technology provider. I'm joined by Michael Clues, Jacob Rank-Broadley and David Bull, and I'll hand over to each perspective just to introduce themselves briefly. Michael.
Yeah, thank you, John. Michael Clues, I'm a director at Deloitte in Germany. I've been working on regulatory topics for more than 20 years now, mainly focusing on Basel-related topics, especially the capital requirements under Pillar 1 and Pillar 2.
Thank you, Michael. Jacob, could I ask you to do the same?
Yep. So I'm based out of our London office. I'm Director of Regulation and Market Structure Propositions. So I lead key initiatives for Refinitiv, including FRTB and certain elements of our LIBOR transition work. Prior to joining Refinitiv, I have a background as a management consultant and also work for a trading platform.
Thanks, Jacob. And then finally, David, if last but not least, David, if you could introduce yourself.
Thanks, John. Hi, everyone. My name is David Bull. I also sit in our London office and sit in the data management and strategy team, responsible for delivering on content or data enhancements around our OTC content sets, so fixed income, commodities, and FX, and also work on a number of our regulatory initiatives within Refinitiv.
Thanks, David. I've seen a few early questions pop up, technical questions about sound. Hopefully those have been addressed. If they haven't, obviously you can't hear me addressing your questions on sound, so apologies for that, but hopefully those have been addressed. So if we move into the first of our poll questions, this is where we ask you, the audience, to be interactive with us and just to articulate what you see in terms of your priorities for the next 12 months with regards to regulatory or market structure changes. So across the list that we have here in terms of some usual suspects, like perhaps FRTB, SFTR, capital floor, CSDR, LIBOR, Brexit, and so on, or other, which could incorporate sort of MiFID and the like as an ongoing change. If you could just answer by interacting with the system what you see as your priorities for the next 12 months. And I shall just flip forward. We'll let this graph settle for a bit. So we're seeing FRTB at about 11%, Brexit 22%, LIBOR perhaps unsurprisingly is a significant front runner at 44% and other at 22% as well. And again, other may be other MiFID changes and so on. Interesting in terms of some of the zeros with regards to capital floor, SFTR, and CSDR. Some of those we'll touch on later. That may change people's thinking as to whether they should be priorities for them within the next 12 months or so. At this point, however, I'd like to hand over to Michael from Deloitte, who is going to run us through a few slides. This is more perhaps presentational aspect of the event, get some and convey some information, and then we'll start moving more into sort of a panel discussion towards the end. So Michael, if I could hand over to you at this stage just to run through your slides.
Yes, thank you. The regulatory roadmap 2020, what lies ahead? That's a good question, and the answer to that question is probably different for every single jurisdiction. And if we could move on to slide 7, please. There are a number of areas which I believe all regulators currently are thinking about. What you see here is a European timeline with some specifics for Germany, but again, the topics should be similar in other areas. What we have in Europe at the moment is the implementation of what the EU Commission calls the risk reduction package. It includes several areas of Basel, most notably the counterparty credit risk, and also to some degree the fundamental review of the trading book, where we see a significant change in the way how exposures and capital requirements are calculated. We'll do a deep dive on the FRTB later in this presentation. But within the package, there are other areas which are also notable. For instance, the interest rate risk in the banking book. So for those banks which do not have a trading book only, but also, let's say, the classic banking business, there was a long discussion whether or not there should be capital requirements on the interest rate risk in the banking book as well. And originally, the regulators decided that the IRRBB would be a Pillar 2 only topic. Like every bank should have an assessment of the interest rate risk and make sure that it is in line with the risk-taking capacity. What has changed now is that, at least in Europe, the regulators can impose capital requirements also for interest rate risk in the banking book if that is deemed to be too big for the size of the bank. Typically, what we notice is a shift in priorities. When Basel II was introduced in 2004, 2006, there was a clear focus on Pillar 1. The formulas presented by the regulators were at the heart of it, and Pillar 2, the internal assessment, was like a backstop. Nowadays, it's more the other way around. The regulators increasingly look at the internal assessment and whether that is in line with the risk-taking capacity. We have CCAR in the US, we have the SREP in Europe, and the Pillar 1 only serves as a backstop, but nonetheless, we will see that later, Pillar 1 is becoming more risk-sensitive, and that means that the calculations within the banks have to be adjusted here. What the regulators still haven't given up on is Pillar 3, the market disclosure. As the calculation rules change, we will also see a different degree of details in Pillar 3 disclosure. That's quite notable also in the context of COVID, as the banks have been asked by the regulators to provide additional information on how COVID does impact their business, how it does impact the creditworthiness of the borrowers. And so disclosure and reporting requirements have increased at rather short notice when the COVID pandemic began. Also included in the risk reduction measures package are MREL and TLAC, the total loss absorbing capacity and the minimum requirements for eligible liabilities. That's something that came up with the financial markets crisis 10 years ago. It's about bail-in capital so that not only the taxpayer will guarantee a bank, but also the customers. The large exposures topic is not a very big topic for the European banks because we've always had requirements on the limitation of large exposures. Nonetheless, we will see some changes here as part of the CRR2 package, most notably that the exposure values will be adjusted because of the changes in the counterparty credit risk. And then we have a limitation for GSIBs, where in the future the maximum exposure will be 15% of eligible capital rather than 25, which it used to be in the past, and which it is for non-GSIBs doing business with each other. Then we have one more topic which has not progressed for quite a long time, and that's how to deal with sovereign risk. We saw a consultation paper on this topic in 2017, and nothing much has happened ever since. It's a very difficult topic. In most jurisdictions, the Treasury or Ministry of Finance is responsible both for the government bonds and also for banking supervision. From a banking supervision perspective, higher risk weights for sovereigns are desirable. On the other hand, it means that the cost of funding for the Treasury will increase, so they have a self-interest in keeping the risk weights as low as possible to make it cheaper for them to go to the bond market. So I wonder when we will see any progress here. And just as an example for a lot of other details, we have definition of default. The definition has been altered in Europe recently to make sure that we have a uniform definition across all banks. And this will come into force at the latest end of 2020. Apart from that, we have...
And Michael, sorry, it's John here. In terms of your conversations with your clients, what sort of level of maturity are clients at in implementing some of these, and what sort of challenges are they facing in implementing some of these initiatives?
What's definitely is the biggest problem at the moment is the counterparty credit risk. Simply because the way how to calculate the exposures and the outstanding amounts has changed. This is a data issue. It has to be implemented all the way from front office to regulatory reporting, and it does take some time. And together with the large exposure regime, it means that banks will have to look at the limits that you have with other counterparties, make sure that when the rules become effective, which is the summer of 21 for Europe, that the actual exposure does not exceed the permitted exposure. So this is, at least that's my perception, where banks are struggling with the most at the moment. IRRBB also bothers some banks, but this has been a topic that has been under discussion for quite some time, and some regulators have pushed it harder than others, so some banks are better prepared than others.
Thank you.
Okay, what's also on the list, other regulatory topics, that's the EU benchmark regulation, and that's the European requirement which brought the LIBOR topic on the table. It's not just LIBOR, but all reference rates which are used as a benchmark have been reassessed. So this is an international topic, and we will have a bit more detail on that one later. Non-performing loans do worry at least the European regulators at the moment. That already was in times before COVID, making sure that every bank has proper provisioning for any loans, any deals which look somewhat tainted. AML, money laundering, is an ongoing topic. When we have the implementation date of an EU directive, we typically see that discussions for the next round starts. And the latest one, the fifth directive, became effective in January this year in Europe. And as I said, discussions have already started on the next round. Then more general internal governance is on the table and has become more prominent as part of sustainability. When the regulators talk about sustainability, they not only have the environment on their mind, but also topics such as discrimination, board oversight, and other topics, making sure that the banking business in general is sustainable. And we've seen a significant amount of new releases in the recent months. It has slowed down a bit because of COVID, but it's still very high on the regulators' priority. The only problem is that there are no common definitions at the moment, and a lot of regulators are trying to establish their own view. Last month, the ECB has come up with their own document on this topic, hoping to streamline the various national activities. But as I said, there's no common taxonomy at the moment. Everybody's working on it, but it's not yet where the regulators want it to be. And I assume that this will remain high on the agenda for a couple of years, since we're only at the beginning of that topic. So that's basically an overview of the topics. As I said, it might look different in your local jurisdiction, but to my knowledge, many regulators are working on these topics at the moment. Okay.
Thank you, Michael. If I can pause there, we've had some questions coming in from the audience already. So many thanks for those who have submitted some questions. It's great that we get that sort of level of interaction. One of the questions that came through saying, and I know this is perhaps going to be based on conversations or insight that you have with the regulators, is whether you're seeing changes in regulations as a consequence, or any change in trends of regulation as a consequence of coronavirus, particularly around market abuse, market manipulation, post-coronavirus. So a question from the audience really is whether we're seeing any trends, or whether we anticipate any trends in a regulatory sense in that direction. Be useful to see your thoughts, or whether you're having those conversations with any regulators or banks at the moment.
meeting the clients is difficult in these times, so this is probably only a limited view. What we do observe is that the COVID pandemic has slowed down some regulatory activities. Also, the regulators had to find ways how to work from home, how to make sure that it works efficiently. They have to take some short notice action to make sure that the banks are treated properly. But I assume that this will just be a temporary thing. What we have seen, for instance, is the German regulator having a more generous view on trades being conducted from out of the office. Well, obviously, there's hardly anybody on the trading floor at the moment. And in Germany, it was a strict requirement that all trades must be done from the trading floor, and that the recording of these trades is conducted in a proper manner and so on. So there's been some relief on that one. There have been some delays in other areas simply because the regulators couldn't keep the pace. We have seen some other initiatives which are in favor of banks to make sure that the impact on them will be less hard than it might be. Talking about CRR2, some items which are favorable could become effective earlier than originally planned. Some items which will put additional burden on the banks, like a higher leverage ratio for global significant banks, might be introduced at a later stage than originally planned. So to sum it up, the regulators are having a close look at what's going on in the market where there are problems, and they try to respond accordingly.
Thanks. Okay, let's push on.
Okay, so then I will continue with a deep dive on Basel III final, or is it Basel IV? The problem is, if you ask the regulators, there is no such thing as Basel IV. The regulators always talk about the finalization of Basel III. I have the impression that they want to avoid the impression that Basel III hasn't been successful and that they need to take it to the next level, labeling it Basel IV. So the finalization of Basel III and Basel IV, as the most consultants call it, is the same thing. What's on the agenda? Basically, as a response to the financial market crisis, the regulators had a close look at what are eligible capital instruments and how much capital should a bank have. And the finalization now pretty much looks at the risk. So how to calculate the risk-weighted assets. We have proposals that became final in 2017 on credit risk for both the standardized approach and the IRBA. We have revised rules for CVA. We have revised rules for counterparty credit risk, a completely new framework for securitizations, the fundamental review of the trading book for market risk. Op risk is on the agenda. We will learn about capital floors in a minute, and then we saw some additional changes to the leverage ratio. So basically, they didn't leave a stone unturned. And as a response to the COVID crisis, it was decided that the international framework shall not be introduced from 2022 onwards, but they postponed it by 1 year to 2023. Speaking for Europe, we do not have a proposal for most of the areas right now. The original plan was that the European Commission would present it in summer this year. And after that, the political discussion would have started. Because of COVID, we now expect that the CRR3, which will include the new rules, could be published by the end of the third quarter or early fourth quarter 2020, so in roughly 3-4 months' time. Keeping in mind that the political discussions in Europe typically take 2 years, we may have the final rules by the end of 2022, and then typically 2 years for implementation are granted. So it is very, very unlikely that the Europeans could have met the 2022 deadline, and even 23 seems very unlikely, in my opinion. If we perhaps could go to slide 9. So the delay in Europe, the delay of the Basel Committee will have limited impact for the European banks, and other regulators also have responded that they will probably not make it until 2023. For instance, I have to look at my notes, but for Canada and Australia, I've been told that they are already looking at 2024 for the new rules. Then we have one additional topic. Whatever is decided in Basel is not binding. And in the past, the European Commission has made use of that fact and introduced rules which altered differentiated quite significantly from the Basel decisions. And for market risk and also for securitization, we have seen that once the European proposals were out, the Basel Committee has modified what was deemed to be the final paper for securitization even twice. So I could very well imagine that once the European Commission has presented how they wish to implement Basel III in Europe, we may see additional changes to the Basel framework. So this, to some degree, remains a moving target, and hopefully by end of the year, we will at least know what it looks like in Europe. For other jurisdictions, for instance, the US, they also have not yet presented the local adaptation of the new rules. So we are not yet sure what it looks like. And again, there's quite a high probability that the 2023 deadline will not be met by many jurisdictions, and it will potentially leave you with more time until the new rules become effective. What's in it? That's slide 10. Just a few highlights for the standardized approach of credit risk. The aim is to make it more risk sensitive, but at the same time less dependent on external ratings. We see new exposure classes. We see recalibrated risk weights, more differentiated risk weights, and also modified conversion factors. So the capital requirements under the standardized approach of credit risk could look quite different from today's capital requirements. For the IRBA, the changes are less obvious, but most notably, the full IRBA, the advanced approach, is no longer permitted for some exposure classes, which means that either the foundation approach has to be applied, or in some cases, even the standardized approach, because of some portfolios, there will be no IRB at all in the future. The idea behind that is to make capital requirements between the standardized approach and the IRBA more comparable. As a part of the recalibration, we have the lowest standard LGD, which today is 45% in the foundation approach. This will be lowered to 40%, which means, in theory, a reduction in capital requirements, and also the scaling factor 1.06, which was introduced at the latest stage of the Basel II implementation, will also be eliminated. So capital requirements under the IRBA can potentially go down. For operational risk, we have a completely revised framework with only one approach remaining, which also means that we will have no internal approach, no advanced measurement approach in the future. We have a business indicator, which is similar to today's business indicator in the standardized approach for operational risk, but we have new mathematics. Today we have the net of all relevant factors, and in the future the net will be calculated for corresponding expenses and profits, and in some cases we have only the higher of income and expenses in the indicator. So that's quite likely to go up. And also the new standardized approach for operational risk will use the bank's own loss history via a so-called loss multiplier. Banks which have a very good history of operational risk losses can see a multiplier which is at the best only 50% of the typical capital requirements, whereas banks with a bad loss history will see higher capital requirements than their peers. And then ultimately, Basel IV, or the finalization of Basel III, will introduce the so-called output floor. This means that any bank using any internal approach, like the IRBA, internal market risk model or whatsoever, is required to calculate in parallel the corresponding standardized approach. And the capital requirements from the standardized approach will have to be published as part of the Pillar 3 disclosure. On top of that, the capital relief by using internal models will be limited, and how that works we see on the next slide. The idea is that
the output will have a big impact in terms of people's approach to wider implementation of the regulation. I think it could change their approach to what they do.
For the market risk, it's simple, because we see a change here under the fundamental review of the trading book from value at risk to the expected shortfall. And also the permission to use internal models will be granted on a trading desk basis. This means that all banks have to reapply for the use of internal models. And if the internal models are not, if the permission is not granted, these banks will be required to stick to the standardized approach. For credit risk, the answer is less obvious, because looking at the wording of the Basel Committee, there's no return to the standardized approach, with the exception of those portfolios where the IRB will be abolished as part of Basel IV. So I hope that banks will be permitted to return to the standardized approach, because the cost of running internal models will increase, as you always have to do the standardized approach in parallel, and the benefit will be limited because of the floor. And so for some banks, it may not be desirable to do the calculation of the internal models, because the cost will or might be too high. We have also spoken to several banks on the topic, and from a risk management or capital management perspective, the floor means that you have some strange effects. And because of the limitations of the benefit, we have talked to one client where the credit risk, the IRBA, will eat up the maximum relief that you can get. So the head of market risk approached the head of credit risk and said, "How much do you pay me for not applying for the internal model?" To explain what lies behind, probably have a closer look at the mechanism. The floor means that a bank will have to calculate capital requirements for all business under standardized approach, like standardized approach for credit risk, the standardized approach for counterparty credit risk, for securitizations, for CDA, market risk, and for operational risk. Of course, there's only the standardized approach in the future. And that is the basis for comparison. And then you do the calculation as you would do today. So you use the standardized approach only for those portfolios where you don't have the permission to use the internal approach, and you compare these figures. The floor shall be introduced in 23 with a limitation of 50%, meaning that your capital requirements must be at least 50% of what they would be under an all standardized approach calculation. And then it increases 5% every year until 27, and in 28 it reaches the final value of 27.5%. 72.5%. That means that the maximum relief you can get by using internal models is 27.5%. That's slide 11, please. So the maximum relief, 27.5%, corresponding to a floor of 72.5%. And in that bank, I had in mind previously the maximum relief by using the IRBA is bigger than 27.5%. So if this bank would also apply for the internal model for market risk, there would be no additional benefit from using the internal model. But obviously, if they apply, they have cost of the audit for approval and so on. So the question every bank must ask themselves is, will we be affected by the capital floor? And if so, does it make sense to apply for internal models for market risk, or are we stuck with IRBA models? And even if the floor only becomes effective in 2023, these decisions, especially the application for the trading desk, must be conducted at an earlier stage, and this is something that banks should keep in mind. And also from an implementation perspective, consider the internal models a rebate on the standardized approach. So if you can prove by using internal models that the capital requirements would be lower than 72.5% of the standardized approach, then this is what the ultimate capital requirements will be. But if you are too generous in the implementation of the standardized approach, it means that the overall capital requirements will be unnecessarily high.
Michael, can I? Obviously it's an intricate area, but I'm just conscious of covering some other areas as well. So if I may just sort of move us on and ask the audience, if you like, whether they've had a chance to look at that capital floor and the implications on their organisation. And then after the poll, we'll start broadening it out. We'll change gears slightly into more of a panel discussion. And what I'll do there is I'll look to focus primarily on LIBOR and Brexit, which you indicated right at the outset were the sort of the topics that you were focused on as an audience. So if I may just ask you to respond to whether your organisations have had a chance as yet to look at the capital floor that Michael was just describing. And I'll move on to the answer section. So quite a few of you using the standardized approach. That's something we've seen in the industry as well. And as Michael touched on, you have to use the standardized approach and then perhaps supplement it with internal models. Partially prepared and also unaware of the floor and the implications that it may have. And quite a large proportion of unsure, as to over 60% as to not aware of the floor, unsure of it. So if we move into the next section and we'll look at FRTB, that was 11% of your response. We'll run through that quickly. We'll then look at LIBOR. I want to spend time on LIBOR because that was the vast majority of you, 44% were interested. Jacob, can I pull you in briefly, and we can start the discussion around FRTB?
Certainly can. So as a bit of background, FRTB is part of the Basel III framework, and it's really the element that focuses on market risk. So the main aim here was to address the weaknesses in the framework that's currently in place. It's a pretty complicated patchwork series of requirements, which have really aimed to plug the gaps and the holes that are perceived to be in the current regulation. Without us spending hours on this, it aims to come up with the standardized approach, which is a pre-canned methodology. And for the first time, this needs to be implemented by all banks that are complying with FRTB. This is also designed to be more risk sensitive. So not only do you get a base view, you get a more accurate base view of the level of risk. Now, it's always been the case that this has existed, but the first time this becomes mandatory. Now, over the top of that, we then have the IMA requirements, or the internal models requirements. And that's really designed for those banks that want to manage their risk in a more sophisticated way. Then they can build their own models. And the big change under FRTB here is a level of scrutiny that goes through from a regulatory perspective in terms of getting approval for it. So it's no small change in terms of going through that. And that's why the deadlines have recently been pushed back to 2023. And it also explains, in part, kind of because a huge amount of work needs to be done from a data management perspective. Now, a lot of those elements from a data management perspective are just upgrades to what most institutions are familiar with today. Many firms implement standardized approach, many firms implement internal models approach. It's taking it to the next level. But one area that really stands out as being a real challenge is something called the risk factor eligibility test. And this is a whole new concept from an FRTB perspective. And it mandates that banks have to measure the liquidity or the trading activity associated with the inputs into their model. And that's really designed to ensure that there's a robust data set going into the model so that the output really you can have confidence in. And it's that challenge, not only doing this test, but how to source that data, that becomes a really pithy issue for the industry.
And Jacob, can you we've got real price observations on the slide there. Can you just explain what that means in terms of executed trades and committed quotes?
Yeah, so this idea of making sure that the data that feeds into a risk model is really robust, you have to have some way of coming up with a view of what's good quality versus bad quality data. There's all sorts of ways of generating data, and that doesn't necessarily tell you whether it's good quality. So FRTB introduces the concept of what it calls a real price observation. It's a rather sophisticated or complicated way of saying a trade or a committed quote. So what a bank has to do in this circumstance is source enough executed trade and committed quote data, and then it has to look at that data over the previous year, and it has to look at both the number of days in which it saw trades or committed quotes and the distribution of those. Now, whilst that process is relatively straightforward, given the fact that most market risk models can be very broad in terms of nature, in essence, FRTB is a global regulation, it's a cross-asset class regulation. Doing that on scale can be a real challenge. It's pretty rare that you see most institutions sourcing huge quantities of executed trade data, even in OTC markets, processing that down to manageable levels so it can be operationally dealt with, putting a consistent data model around it, and actually running this test. It really is something which looks simple on paper, but in practice represents a real hurdle for the industry.
And I think it's worth touching on as well that unlike some of the other regulations that we've spoken about here and will speak about, FRTB is global in nature and impact. Absolutely.
Yeah, just the scale of the data access, just to give you some stats. We're working on a project at the moment. Our solution already processes literally billions of trades, and we only have substantial but partial coverage. So by the time we get to that complete level, I wouldn't be surprised if we're talking tens or possibly even hundreds of billions of trades feeding through in terms of actually getting these results. And you pretty quickly realize by the time you're talking about these kind of numbers, that's not straightforward from an operational perspective.
And based on what we've seen to date, what sort of impact for those organisations who are considering internal models, getting this component right, what sort of impact are we seeing on their capital allocations and so on that this can have? What sort of improvement would we see?
So that's a really difficult question, actually, because it's a brand new test. It's really difficult to get a view over how material that could be. There's been a lot of impact studies that have been done. In those impact studies, different assumptions made by different institutions. It can lead to some quite large error ranges around that. But we've seen studies that have suggested that around about anything up to a third of the amount of capital that could be held could be attributed to the risk factor eligibility test. So it's a liquidity test we're talking about. So it's not only operationally difficult, but it's a substantial capital driver if you get it wrong.
Okay, thanks very much. Well, we've got quite a bit to get through still, so I'm going to leave FRTB at that point. If there are any questions that people have, then please fire them in, and if we don't get to them during the course of the event, we will come back and answer those questions. I'm conscious that LIBOR and Brexit were our top two. So LIBOR and huge impact of the migration away from LIBOR. One question that we have had come in at a very high level is the move away from LIBOR end of 2021. How realistic do the panel think that is, given the scale of exercise that's got to be addressed by the industry? Jacob, let's start with you.
The scale of the challenge. So the thing that scares me most, LIBOR represents us at approximately 3.5 times the world's GDP in terms of contracts exposure. It's used in derivatives, it's used in securities, it's used in loans. So my big fear is the fact that you've got this this number which has been embedded from a financial services perspective through pretty much everything that you can come to. Back in 2017, when Andrew Bailey announced that LIBOR was no longer going to be supported from the end of next year, I think 4 years sounded like it was quite a long period of time to address a challenge like that. When you sit here today, you realise that that's a year and a half away, and you look what the industry has to do. It's a pretty terrifying challenge ahead of us. So I think it's perfectly doable with this timeline, but it needs huge commitment from the industry to get there on time.
I think it's maybe worth. Sorry, John. I was going to say it's maybe worth.
You go ahead.
It's maybe worth adding. I think the FCA and the Fed and sort of the regulators out there are pretty adamant still, despite the COVID crisis, that they want to sort of hit that end of 2021 deadline. And I think we're seeing regular sort of messaging coming out from them that while they've moved some of those interim milestones, along the way, the date at the end of the year, 2021, is still the one that they're very much aiming towards.
Yeah, I mean the Sterling Working Group's announcement of a up to 6 month delay for the LIBOR migration for loans is a relatively small change from an industry timeline compared to the challenge ahead of us and compared to the disruption that's been produced by COVID. So in my view, it shows absolute commitment to that deadline, not to move the end of 2021 date.
Do you think it'll be a committed deadline? The regulators have form, though, don't they? A lot of stuff went in on MiFID, some stuff has gone in on SFTR, for example, where things like LEI were mandated and then people were given a 6 month window or a 12-month window to implement it. Do you think that the regulators might do something similar with LIBOR, which is stick to the date but give a window of latitude?
Put it this way, John. If I was responsible for our compliance department, I'm not sure I'd want to take that gamble. So
that's fair.
You might well be correct. There is a history of regulators. Regulators do have a tendency of sticking to dates and then moving them at the very last moment. I think they don't want to change those dates any earlier. They do think that if they keep them there, they will keep up the pressure. But whether I want to be the only institution which hasn't made material efforts to move off LIBOR and all of a sudden find that it doesn't exist, operation's going to be pretty tricky, and I don't think my customers are going to be very happy with me if I do that.
And David, you've been in the weeds, at the guts, if you like, at the data end of what we've been having to do around LIBOR and introduction of risk-free rates and so on. What have been your observations from the sort of work you've had to do at the data end in terms of our internal systems that some of the audience may also have to be considering as well?
Sure. I think what we're seeing is many firms and many institutions have already set up LIBOR programs within their institution on how they're actually going to tackle the challenge. And to a certain extent, it's no different how we've been setting ourselves up to respond. I think one of the first exercises that firms are going through is really understanding how they're going to be impacted by the transition and what does that actually mean. There's a certain amount of technology or IT sort of processing challenge that we need to understand where LIBOR is bedded into certain processes within a firm. To do that, they obviously need to know where they're getting LIBOR from today, who's their vendor, how is it actually coming into that system, and then what are they going to actually do to replace it with an alternative reference rate. So that's sort of one of the big challenges. A second is building out inventories and an understanding of what their exposure is. So a lot of firms need to understand, what derivatives or what cash securities do they currently have that are exposed to LIBOR, and what will happen to those securities if they mature going out beyond the 2021 date. And this is where the term, and there's a lot of talk about LIBOR fallback language, which is really that language within, say, a fixed income FRN prospectus that really tells you what will happen to a fixed income bond if LIBOR was to cease to exist. What we've seen and what a lot of the sort of industry seen is that language is written into a bond prospectus, for example, in legal text, but it's not something that's necessarily always been captured historically. So we've had to update our databases and our products to be able to capture that information in a structured way, and be able to sort of look to backfill and cleanse it and make it available out to some customers who will need that. Another key area is obviously, Jacob will probably talk about alternative reference rates and term rates that are sort of coming out, but a lot of the recommended risk-free rates, alternative reference rates are overnight rates, whereas LIBOR is obviously a forward-looking term or forward-looking tenor. The impact this has on something like a bond, for example, means that the way that coupon calculations or FRN calculations will need to be handled are very different to how they're handled today for LIBOR bonds. So, making sure that we have the right analytics and the right calculators and the right reference data fields available within our products and making them available down our feeds to allow customers to actually correctly calculate a FRN, which has a backward-looking rate, has become really sort of important and something that we've had to get ready now rather than be ready for a year and a half's time, because what we're seeing is a lot of new instruments being issued against the new risk-free rates today.
Thanks, David. Again, any questions on LIBOR that people have, please submit them if we don't get a chance to question them. The panel now, we will look to respond to you directly. Again, just finally, in the last couple of minutes, as we sort of wrap up, the audience indicated Brexit, 22%. I'm going to make the assumption that that's sort of the lights of what's going to happen to things such as MiFID and some of these other European regulations as a consequence of Brexit. We're seeing already FCA making respective moves in terms of thresholds and so on. So there'll be FCA thresholds versus ESMA thresholds. David, what are you observing that we are, again, coping with in terms of, and again, our clients will have to cope with regard to new venues on the market, new MIC codes, as well as new thresholds?
So from a trade and transaction reporting perspective, which are really driven by some of the information that's provided by ESMA, whether it's a TOTV or traded on a trading venue flag, or like you said, the liquidity status of an instrument or thresholds. In a post-Brexit world, FCA, the UK regulator, will also provide equivalents to those EU or ESMA values. I think what we've seen is a lot of preparation was done within the industry and also by ourselves to be ready for a hard Brexit back in April or as initially as it was at the end of last year. So to a certain extent, those fields have been incorporated into as placeholders into the actual reference data products to be populated as and when FCA actually makes them available live. We've seen that FCA's already provided a version of their FIRDS database, and they've sent out some test files in for the transparency level. I think what we'll see from next year at some point is, initially I think the ESMA and the FCA values will be the same, but at some point, we could see FCA determine and calculate their own values on the back of information reported in the UK.
Okay, thanks, David. Well, as is always, time flies when you talk regulation, and we've hit the hour. So I would just like to say thank you very much for your attendance and for joining us today. Materials, recordings, websites, and so on will be made available to anyone who requires them, be it some of the Deloitte papers that can go into specific detail, be it the presentation or be it the recording itself. But otherwise, thank you very much for joining us today, and continue to stay safe. Thank you.